In the grand casino of the global markets, where fortunes are made and lost in the flicker of a screen, we are taught to worship at the altar of numbers. We analyze price-to-earnings ratios. We dissect discounted cash flow models. We chart moving averages and debate the arcane signals of quantitative easing. We believe, with an almost religious fervor, that the secret to wealth management lies buried in a spreadsheet, a secret that can be unlocked if only we find the right formula, the right metric, the right algorithm. We hunt for the genius chief executive, the one with the stratospheric IQ, the MBA from a hallowed institution, the visionary who can paint a dazzling picture of a future dominated by their product. We listen to them on earnings calls, hanging on every syllable, convinced that their intellect is the primary asset we are buying. But what if this entire approach is a dangerous illusion? What if the most important metric isn't on the balance sheet at all? What if a CEO's brains don't matter nearly as much as their character? Warren Buffett, the man who built a $600 billion empire from the Dust Bowl of Omaha, Nebraska, has a radically different view. He suggests that after a certain level of intelligence, the traditional markers of success become almost meaningless. Instead, he proposes a test so simple, so profoundly human, that it feels almost heretical in the world of high finance. It's a principle he has used to protect his portfolio and achieve a level of financial freedom others can only dream of. He calls it the newspaper test. The rule is this: only partner with people, only invest in companies run by people whom you would be perfectly happy to see featured in a story on the front page of your local newspaper, written by a smart but not so friendly reporter. Think about that. Not a fawning profile in a business magazine, but a critical examination in your hometown paper, the one read by your neighbors, your family, your friends. It's a test of integrity, of character, of fundamental decency. It's a filter designed to prevent the single most costly mistake an investor can make: entrusting your capital to a shady, overly promotional, or fundamentally dishonest manager. By making this principle the cornerstone of your investment philosophy, you undergo a profound financial transformation. You stop chasing brilliant charlatans and start partnering with trustworthy stewards. You learn to prioritize management honesty and rationality above all else, ensuring that your hard-earned capital is being guided by partners whose interests are perfectly aligned with your own, safeguarding your journey towards long-term financial success. This is the final promise of prudent investing. That character, not calculus, is the ultimate guardian of your wealth. The first pillar of this entire philosophy, the very foundation upon which a sound investment house is built, is what we will call the integrity litmus test. It is the recognition that a business is not a collection of assets and liabilities. It is a human enterprise, and the character of the humans at the helm will ultimately determine its fate. Integrity is not a soft feel-good quality. It is a hard financial asset. Its presence creates a durable tailwind for shareholder returns, while its absence creates a hidden, unquantifiable risk of catastrophic failure. No story illustrates this more viscerally, more terrifyingly, than Warren Buffett's trial by fire in the Salomon Brothers scandal. To truly understand the power of the newspaper test, we must travel back to 1991. The world of finance was a different place, a swaggering, high-stakes arena dominated by powerful investment banks. Among the titans was Salomon Brothers, a legendary bond-trading powerhouse. Buffett, through Berkshire Hathaway, was its largest single shareholder, with a $700 million preferred stock investment that yielded a handsome 9%. He wasn't involved in the day-to-day operations. He had invested in what he believed was a powerful franchise run by competent people. The man at the top was John Gutfreund, a figure lionized in the Michael Lewis book Liar's Poker, a man once dubbed the King of Wall Street. He was intelligent, aggressive, and commanded immense respect. But in the spring of 1991, a cancer began to grow in the heart of the firm. A rogue trader, the head of the government bond desk named Paul Moser, had been breaking the rules. The U.S. Treasury, to prevent any single entity from cornering the market, had a rule that no firm could bid for more than 35% of the bonds in a single auction. Moser, in his hubris, had not only bid the maximum for Salomon, but had also submitted unauthorized bids in the names of two of his clients to get around the limit, effectively cornering the market. This was not just a breach of etiquette, it was illegal. In late April, the top management of Salomon, including John Gutfreund, was made aware of Moser's actions. Here is the moment where the integrity litmus test begins. What does an honest manager do? What does a person who would be comfortable seeing their actions on the front page do? They act. They self-report. They lance the boil immediately. But Gutfreund and his team did nothing. They delayed. They equivocated. For months, the illegality was an open secret within the firm's leadership, a ticking time bomb. By August, the bomb detonated, the scandal broke, and it was a firestorm. The U.S. government, Salomon's single most important counterparty, threatened to ban the firm from bidding in treasury auctions, a move that would have been a death sentence. The firm was facing a full-blown liquidity crisis. Clients fled, credit lines were pulled, and the entire edifice of this Wall Street giant, built over decades, was hours away from complete collapse. Buffett, sitting in Omaha, saw his $700 million investment evaporating before his eyes. But more than that, he saw the reputation of Berkshire Hathaway, his life's work, being dragged through the mud by association. He was forced to fly to New York and take control. In a dramatic weekend showdown, Gutfreund and the other top executives were forced to resign, and Buffett, against every one of his instincts, agreed to become the interim CEO of Salomon Brothers to save the firm from oblivion. His first job was to go to Washington and plead for the firm's life. It was during his testimony before Congress that he articulated the very core of this pillar. He looked the lawmakers in the eye and said, "Lose money for the firm and I will be understanding. Lose a shred of reputation for the firm and I will be ruthless." This was not a platitude. This was a scar speaking. He had witnessed firsthand how decades of financial success, billions in profits, and a world-class brand could be vaporized in an instant by a single failure of integrity at the top. The failure of John Gutfreund to pass the newspaper test, to do the right thing immediately and transparently, almost destroyed one of the most powerful firms on Wall Street and cost Berkshire Hathaway hundreds of millions of dollars. The experience seared a lesson into Buffett's soul. The numbers on a balance sheet are meaningless if the people producing them lack character. The reason this lesson is so hard for most investors to learn is rooted deep in our psychology. We are all susceptible to a pair of powerful cognitive biases: the halo effect and confirmation bias. These mental shortcuts, designed to help us make quick judgments in a complex world, become catastrophic liabilities in the realm of stock picking. The halo effect is our tendency to let one positive trait about a person or company color our perception of all their other traits. When we see a company with a soaring stock price, a revolutionary new product, or a charismatic, media-savvy CEO, we subconsciously create a halo around it. We assume that because the stock is going up, the accounting must be clean. Because the product is cool, the corporate governance must be sound. Because the CEO is brilliant on television, they must be a person of high integrity. We project goodness onto the entire enterprise based on one flashy data point. This is where the danger begins, and it is amplified by the second bias, confirmation bias. Once we have formed a positive initial impression, once that halo is in place, our brains begin to actively filter reality to support that conclusion. We seek out bullish analyst reports and positive news articles. We dismiss critical commentary as the ramblings of jealous naysayers or manipulative short sellers. We interpret every ambiguous statement from management in the most favorable light possible. If the CEO announces an expensive, questionable acquisition, we praise their bold vision. If they miss earnings estimates, we accept their explanation of temporary headwinds without question. We become cheerleaders, not analysts, and our capital is put at grave risk. The newspaper test is a powerful psychological tool because it is a direct antidote to these biases. It forces you to pierce the halo. It compels you to stop looking at the soaring stock chart and start looking at the human being behind it. The question is not, is this person smart, or is this company growing fast? The question is, Would I be embarrassed if my neighbor saw a detailed factual story about this person's business practices? This simple reframing shatters the confirmation bias. It forces you to actively seek out disconfirming evidence. You start asking different questions. Why was the CFO replaced so suddenly? Why is the CEO's compensation so much higher than that of their peers for similar performance? Why are they using complex, non-standard accounting metrics to present their earnings? These are the questions a skeptical reporter would ask, and they are the questions a prudent investor must ask. Our brains are fundamentally wired to follow and trust confident leaders. It's an evolutionary trait. But in the modern market, a confident leader might just be a skilled sociopath. The newspaper test acts as a cerebral circuit breaker, momentarily disabling our instinct to trust and enabling our capacity for critical judgment. It forces a cold, objective analysis of character, a dimension completely absent from the standard financial models that lead so many retail investors astray. So how do we translate this powerful psychological principle into a practical, repeatable process? How do we build a blueprint for applying the integrity litmus test to any potential investment? This is not about gut feelings. It is about a systematic process of character due diligence. Here is a 5-step mental model that any investor, from a beginner managing their own retirement account to a professional overseeing a large portfolio, can use to protect themselves. First, you must go beyond the press release and read the full, unedited transcripts of earnings calls. A press release is a sanitized marketing document. The transcript of the question and answer session, however, is a window into the mind of management. Pay close attention to how they answer tough questions from skeptical analysts. Are their answers direct, clear, and backed by data? Or are they evasive, filled with corporate jargon, and designed to obfuscate rather than clarify? An honest CEO, when asked about a problem, will address it head-on. A dishonest one will pivot, deflect, and try to change the subject. Look for humility. Listen for the words, "We made a mistake," the rarest and most valuable words in any corporate communication. Second, analyze the letter to shareholders in the annual report. Don't just read the most recent one. Go back and read the last 5, or even 10. Is there a consistent, candid narrative? Does the CEO openly discuss challenges and failures, taking responsibility for them? Or is every single year a triumphant victory lap where successes are attributed to managerial genius and failures are blamed on the economy, the weather, or a competitor's unfair practices? Warren Buffett's own letters are the gold standard. He often spends more time discussing Berkshire's mistakes than its successes. This kind of transparency builds trust, the most critical currency a CEO has. Third, you must scrutinize insider transactions. Actions speak louder than words. A CEO can spend an hour on television talking up the company's glorious future, but if they and their entire executive team are systematically selling large blocks of their stock, what does that tell you? You must follow the money. Are insiders buying stock on the open market with their own cash? This is a powerful signal of their true belief in the company's future. Conversely, consistent, heavy selling, especially when not part of a pre-scheduled plan, is a massive red flag that the people who know the most are quietly heading for the exits. Fourth, investigate past behavior. The internet has made this easier than ever before. Before you invest a single dollar, perform a detailed search on the CEO and other key executives. What was their track record at their previous companies? Were there any past controversies, shareholder lawsuits, regulatory investigations, or bankruptcies? Character is consistent. A manager who played fast and loose with accounting rules at their last job is highly likely to do the same at their current one. As the old saying goes, a leopard doesn't change its spots. Finally, apply the newspaper test directly and literally. Take a specific action the company has taken. A recent acquisition, the structure of the CEO's bonus, a decision to lay off employees while management took raises, and write it out as a headline. For example, CEO John Doe receives $50 million bonus after laying off 10,000 workers. Or, XYZ Corp spends $2 billion on naming rights for sports arena amidst falling profits. How does that headline feel in your gut? Does it feel like a story of prudent, shareholder-focused action? Or does it feel like a story of greed, ego, and a disconnect from the owners of the business? This simple visualization can cut through pages of financial analysis and give you a clear, immediate sense of the character of the people you are about to partner with. The power of this mental model becomes starkly clear when we examine its opposite, the path that the vast majority of investors, the 99%, take. This is the path of chasing the story stock. The 99% are not buying a piece of a business, they are buying a narrative. They fall in love with a charismatic CEO who tells a seductive story about changing the world. Think of a figure like Adam Neumann of WeWork. He wasn't selling office space, he was selling the future of work, a global consciousness, a movement. The story was intoxicating. He was a brilliant promoter, a master storyteller who could convince sophisticated investors to pour billions of dollars into a fundamentally unprofitable real estate company. Investors on this path ignore every red flag because they are so invested in the narrative. They don't read the fine print in the financial statements that show staggering losses. They don't question the bizarre corporate governance structures designed to give the founder unchecked power. They don't scrutinize the CEO's personal enrichment at the company's expense. They see the charisma, they hear the story, and they click buy. They join online communities that become echo chambers, where every member reinforces the collective belief in the story and viciously attacks anyone who dares to question it. They are part of a movement, and it feels good, exciting. The stock price soars based on pure hope and hype, reinforcing their belief that they have found the next big thing. But stories are not cash flow. Hype is not profit. Eventually, gravity reasserts itself. The narrative collides with financial reality, and the entire structure collapses. The stock price plummets 90% or more, and the believers are left holding a worthless bag, wondering what went wrong. What went wrong is that they never applied the integrity litmus test. They never asked the simple question, would I be proud to have the full story of this company's operations and its leaders' behavior detailed on the front page of my local paper? For WeWork, the answer would have been a resounding, embarrassing no. The 99% chased the sizzle. The wise investor, the one focused on long-term portfolio protection, buys the steak, and the steak is always, always made of integrity. Ultimately, this principle of integrity has a direct and powerful connection to the financial statements and your long-term returns. This isn't just a moral preference, it's a financial strategy. We can think of this in terms of two invisible, but very real, forces acting on a stock's valuation: the integrity premium and the fraud discount. Companies led by management teams with a long, demonstrable history of honesty, transparency, and shareholder-friendly actions often trade at what looks like a higher valuation, a higher price-to-earnings ratio, for example. Many investors see this and conclude the stock is expensive, but this is a mistake. That higher price contains an integrity premium. You are paying a little extra for the drastically reduced risk of a catastrophic blow-up. You are buying the certainty that the reported earnings are real. You are buying the assurance that capital will be allocated wisely. This premium is a form of insurance, and over the long term, it is one of the best bargains in the market. On the other side of the coin is the fraud discount. A company run by a promotional CEO with a history of questionable accounting might look cheap on paper. It might have a low PE ratio. But this low valuation is not an opportunity. It is a warning. The market is subconsciously applying a discount to the stock because of the perceived lack of integrity at the top. The fraud discount represents the massive, unquantifiable tail risk of a sudden disastrous event. This could be an SEC investigation, a major accounting restatement that wipes out past profits, or a scandal that destroys the company's brand. When you buy a stock like this, you are not getting a bargain. You are picking up a penny in front of a steamroller. Integrity directly impacts the quality of earnings, a crucial concept in professional stock analysis. High-quality earnings are real, sustainable, and backed by cash flow. Low-quality earnings are the product of accounting tricks and one-time events. A management team with integrity produces high-quality earnings. A team without it will always be tempted to manipulate the numbers to hit short-term targets. By focusing on integrity, you are naturally biasing your portfolio towards companies with high-quality earnings and therefore a much higher probability of sustainable, long-term success. It is the single greatest risk management tool at your disposal. The second great pillar, flowing directly from the first, is what we will call the rationality engine. Integrity ensures that a CEO won't lie to you, but it doesn't guarantee they won't do foolish things. Rationality is the crucial other half of the equation. It is the ability of a manager to think independently, to make decisions based on logic and evidence, and most importantly, to allocate the company's capital in a way that maximizes long-term, per-share value. A rational CEO resists the siren song of corporate fads and the immense pressure to simply imitate what their competitors are doing. No one in Buffett's world embodied this principle better than Tom Murphy, the former CEO of Capital Cities/ABC. Buffett has stated on numerous occasions that Tom Murphy is, in his opinion, the greatest business manager he has ever met. The story of Capital Cities is a masterclass in rational capital allocation. Murphy and his partner Dan Burke ran their company with a relentless focus on cash flow and returns on investment. Their management style was famously decentralized. They hired the best people they could find, gave them the resources they needed, and then got out of the way. But when it came to major capital decisions, Murphy's logic was absolute. The most legendary example of this was the audacious acquisition of ABC in 1985. At the time, Capital Cities was a collection of television stations and publications, with revenues of about $1 billion. ABC was a broadcasting titan, more than 3 times its size. On paper, it looked like a minnow swallowing a whale. Deals like this are often driven by pure ego, the desire of a CEO to build a bigger empire. But for Murphy, it was cold, hard math. He saw that ABC, despite its prestige, was being run inefficiently. He knew that by applying the same operational discipline and cost controls that had made Capital Cities so profitable, he could dramatically increase ABC's cash flow. Berkshire Hathaway helped finance the $3.5 billion deal, a testament to Buffett's faith in Murphy's rationality. The acquisition was a stunning success. Murphy and Burke didn't fall in love with the glamour of running a major network. They ran it like a business. They sold off assets that weren't generating sufficient returns. They cut unnecessary costs that had bloated the organization. They focused every decision on the simple question, will this increase the long-term value of the business? This rational, unsentimental approach to management created enormous value for shareholders over many years. It was the polar opposite of the typical empire-building CEO, who measures success by the number of employees they have or the square footage of their corporate headquarters. Tom Murphy measured success by the growth of intrinsic value per share. His career is the ultimate foundational anecdote for the power of a rational mind at the helm, a mind that treats shareholder capital not as a tool for personal aggrandizement, but as a precious resource to be compounded intelligently over time. Why is this kind of rational decision-making so incredibly rare in the corporate world? The answer lies in another powerful psychological force that Charlie Munger, Buffett's longtime partner, brilliantly identified and named the institutional imperative. This is the pervasive, often unconscious tendency for organizations to mindlessly imitate their peers, regardless of whether the imitative actions are logical or value-creating. The institutional imperative manifests in several destructive ways. A company will continue to operate a money-losing division simply because it has always been there, and shuttering it would be an admission of failure. A board will approve a foolish acquisition at the peak of a market bubble because all of its competitors are doing similar deals, and they don't want to be seen as missing out. This pressure is amplified by another bias known as social proof. We are social creatures, and we have a deep-seated instinct to follow the herd. When everyone around us is doing something, we assume it must be the correct thing to do. In a corporate boardroom, if 5 competing companies have all launched expensive, high-risk ventures into a trendy new technology, The pressure on the CEO of the sixth company to do the same is almost unbearable. To stand alone and say, "No, that doesn't make sense for us," requires immense psychological fortitude. The rational CEO, the Tom Murphy or the Warren Buffett, is the one who has the internal wiring to override these powerful psychological currents. They are able to look at a popular trend and analyze it from first principles, asking, does this actually make sense for our specific business? Are the potential returns worth the risk? They have the discipline to sit on a growing pile of cash for years, patiently waiting for a truly great opportunity, while their peers feel a frantic need to do something, anything, to create the appearance of action and justify their exorbitant salaries. They would rather take a little criticism for inaction in the short term than risk the permanent destruction of capital by making a foolish, herd-driven decision. The institutional imperative and social proof are the enemies of good capital allocation. A rational CEO is a warrior who actively fights against these forces every single day, guided not by what is popular, but by what is smart. This independent-mindedness is an incredibly rare and valuable trait, and identifying it in a management team is a key task for any serious investor looking to achieve beating the market. To turn this understanding of rationality into a practical tool, we need a blueprint, a systematic way to audit a management team's capital allocation decisions. This is the capital allocation audit, a 5-step process to determine if a CEO is a true steward of shareholder value or just another empire builder. First, you must track the flow of cash. For the last 5 to 10 years, find out where every dollar of the company's free cash flow has gone. Create a simple chart or spreadsheet. The main categories will be dividends paid to shareholders, money spent on share buybacks, cash used for acquisitions, funds used to pay down debt, and capital reinvested back into the core business. The pattern of this cash flow over a long period tells you the true priorities of management. Second, evaluate their share buyback programs. On the surface, buybacks sound great. They reduce the number of shares outstanding, increasing earnings per share. But a rational manager only buys back stock when they believe it is trading for less than its intrinsic value. An irrational manager, often goosed by an options-heavy compensation plan, will buy back stock at any price, even at all-time highs, simply to prop up the stock price and make their quarterly numbers look better. Look for a history of opportunistic buybacks at low prices, not a consistent program that buys more as the price gets higher. Third, analyze the company's acquisition history. This is often where the most value is destroyed. For each significant acquisition, ask, what was the purchase price as a multiple of the acquired company's earnings or cash flow? Was it a strategic fit, operating within the parent company's circle of competence? And most importantly, what has the return on that invested capital been since the deal closed? A history of disciplined, value-accretive deals is the mark of a great capital allocator. A history of expensive, unrelated acquisitions, a process Buffett calls diversification, is a giant red flag. Fourth, assess the returns on internal reinvestment. Not all cash is spent externally. Companies also reinvest in their own operations, building new factories, funding research and development, etc. The key metric here is return on invested capital, or ROIC. A rational manager will only pour more money into the business if they can confidently expect to earn a high rate of return on that capital, a return that is higher than what shareholders could likely earn by investing that same money in a simple index fund. Consistently high and stable ROIC is the hallmark of a great business run by a rational team. Finally, apply the do-nothing test. This is perhaps the most subtle but most important test of all. Look for long periods, especially during frothy, speculative markets, where the management team demonstrated the discipline to simply hold on to cash and do nothing. This is incredibly difficult. They face pressure from Wall Street analysts and shareholders to, quote, put the cash to work. A CEO who can resist this pressure, who has the patience to wait for the fat pitch, is a CEO who is truly thinking like an owner and is focused on preserving capital, not just generating activity. This discipline is the ultimate sign of rationality. When you fail to conduct this kind of audit, you fall prey to the antithesis of this pillar, the folly of investing with the deal-a-day CEO. This is the celebrity executive who is addicted to the thrill of the deal. Their face is constantly on the cover of business magazines, and they are lauded by the financial media as a bold visionary. Their ego is inextricably linked to the size and growth rate of the empire they command. They are not content to manage a profitable, steadily growing business. They must constantly be acquiring, merging, and expanding. These CEOs overpay for acquisitions, using shareholder money as their personal poker stake. They are seduced by vague concepts like synergy and transformational deals. They believe their brilliance can overcome the terrible economics of the transaction. They load up the company's balance sheet with massive amounts of debt to finance their ambitions. The result is almost always a disaster. The promised synergies never materialize. The acquired company is difficult to integrate, leading to a clash of cultures and operational chaos. The core business suffers from a lack of focus as management's attention is diverted to the new, shiny toy. The massive debt burden becomes an albatross around the company's neck, strangling its ability to invest for the future. The quintessential example of this is the disastrous AOL-Time Warner merger in 2000. It was the peak of the dot-com bubble, a deal driven by hubris and a complete detachment from financial reality. The architects of the deal were hailed as visionaries, creating the first vertically integrated media company for the 21st century. But the underlying logic was deeply flawed, the cultures were incompatible, and the price paid by AOL was astronomical. The merger resulted in one of the largest annual losses in corporate history and a staggering destruction of shareholder wealth. Retail investors who were lured in by the grand vision, who invested with the deal-a-day CEOs, were utterly decimated. They confused activity with progress and grand pronouncements with rational strategy, a mistake that a simple capital allocation audit would have helped them avoid. The direct financial connection between management rationality and shareholder returns is clear, powerful, and mathematical. It can be summarized in 3 letters: ROIC, or return on invested capital. This metric tells you how much profit a company generates for every dollar of capital that has been invested in the business. A rational CEO who consistently allocates capital to projects, acquisitions, and buybacks that generate high returns, say a consistent ROIC of 15% or 20%, is effectively running a powerful compounding machine for shareholders. The company's intrinsic value grows at a rapid clip because its capital is being deployed so efficiently. An irrational CEO, the empire builder, might generate headline-grabbing revenue growth through acquisitions, but if those acquisitions were overpriced or poorly integrated, they will generate a low or even negative return on the capital invested. This is the activity that destroys total value. A company can grow its revenues by 50%, but if its ROIC is only 5%, it's a terrible business that is trapping shareholder capital in low-return ventures. The stock price of a company over the long term is destined to follow the trajectory of its ROIC. High and sustainable ROIC is the primary engine of long-term stock price appreciation. And high and sustainable ROIC is the direct, undeniable fruit of a rational management team making disciplined capital allocation decisions year after year. When you invest, you are not just buying a company's assets, you are hiring its management team to be your capital allocators. Choosing a rational team is the single most important hiring decision you will ever make in your entire financial life. This leads us to the 3rd critical pillar, an idea that ties integrity and rationality together, the circle of competence alliance. This is the principle that the best managers are not only honest and rational, but they are also honest about the limits of their rationality. They have a deep, humble understanding of what they know and, more importantly, what they don't know. They stay laser-focused on their core business, the area where they have a genuine and durable competitive advantage, and they resist the temptation to wander into fields where they are amateurs. This requires an immense amount of discipline, the power to say no to trendy ideas and seemingly exciting opportunities that lie outside their expertise. There is no more powerful foundational anecdote for this principle than Warren Buffett's own conduct during the dot-com bubble of the late 1990s. It's hard to overstate the mania of that era. Any company that added .com to its name saw its stock price multiply overnight. Financial commentators and a new breed of day traders were proclaiming a new paradigm, where old metrics like profits and cash flow were irrelevant. It was all about eyeballs, network effects, and getting big fast. And in the midst of this frenzy, Warren Buffett and Berkshire Hathaway were sitting on the sidelines. The pressure on him was immense. He was publicly ridiculed. A famous cover story in Barron's in 1999 was titled, "What's Wrong, Warren?" The article suggested his value investing principles were obsolete, that he was a dinosaur who simply didn't get the new technology-driven economy. He was underperforming the market dramatically. Younger, flashier fund managers were posting triple-digit returns by loading up on speculative tech stocks. Buffett's response was calm, consistent, and unwavering. He went on television and freely admitted, "I don't know how to value these companies." He explained that he didn't understand their technology, he couldn't predict who the long-term winners would be, and he couldn't project their cash flows 10 or 20 years into the future. Because he couldn't understand them, he wouldn't invest. It was a simple, powerful display of intellectual honesty. He was defining his circle of competence, and he was refusing to step outside of it, no matter how much mockery he had to endure. He wasn't saying that tech companies were bad, he was saying that Sentia was not qualified to judge them. When the bubble burst in 2000 and 2001, the Nasdaq index collapsed by nearly 80%. Trillions of dollars of speculative wealth were vaporized. The new paradigm was revealed to be the same old speculative mania, and the managers who had been hailed as geniuses were exposed as lucky gamblers. Buffett, who had protected his shareholders' capital by sticking to what he understood, businesses like Coca-Cola, Gillette, and See's Candies, was vindicated in the most dramatic fashion imaginable. His steadfast refusal to venture outside his circle of competence wasn't a sign of being old-fashioned. It was the ultimate act of a trustworthy fiduciary, a manager whose integrity extended to admitting his own intellectual limitations. The psychological forces that compel CEOs to stray from their circle of competence are incredibly strong. The first is the Dunning-Kruger effect, a cognitive bias in which people with low ability or knowledge in a particular area tend to overestimate their ability and knowledge. A CEO who has been successful in, say, the retail industry, might look at the software industry and think, "Business is business. I'm a brilliant manager, so I can surely succeed there too." They fail to appreciate the subtle nuances, the different competitive dynamics, and the specific expertise required to win in that new field. Their past success creates an overconfidence that blinds them to their own incompetence in the new domain. This is a classic trap for successful people. The second, and perhaps even more powerful, force is the fear of missing out, or FOMO. This is the primal anxiety that everyone else is getting rich from some new trend and you are being left behind. In a boardroom, FOMO can be a contagion. If competitors are all investing heavily in artificial intelligence or cryptocurrency or some other hot new thing, the board and the CEO start to panic. They feel immense pressure to announce their own strategy for that area, even if they don't understand it, and it has no logical connection to their core business. The fear of looking stagnant is greater than the fear of making a foolish investment. A management team that respects its circle of competence has the rare combination of self-awareness to overcome the Dunning-Kruger effect and the emotional discipline to resist FOMO. They understand that true executive decision-making is not about chasing every opportunity, but about carefully selecting the few that fall squarely within their area of expertise. The ability to say "I don't know" or "that's not our game" is not a sign of weakness. It is the ultimate sign of strategic strength and a commitment to long-term investing principles. How can an outside investor determine if a company's management is staying within its circle of competence? You need a practical blueprint for mapping the moat. This 5-step mental model helps you visualize the company's area of strength and spot any dangerous deviations. First, you must be able to define the core business in one simple sentence. What does the company actually do to make money? If you read their annual report and can't explain their business model to a 10-year-old, that's a huge red flag. It often means the company itself has lost focus. Or, worse, management is using complexity to hide a lack of a coherent strategy. Second, identify the source of the economic moat. What is the company's sustainable competitive advantage? Is it a powerful brand like Coca-Cola? A low-cost production process like Geico? A network effect like Facebook? A patent on a crucial drug? A rational manager who understands their circle of competence will be obsessed with protecting and widening this moat. Third, trace the company's capital expenditures. Where are they investing their money? Is the capital being used to deepen the existing moat? For example, a railroad spending money to improve its tracks, or a software company investing in research and development for its core product? Or is the money being squandered on speculative ventures far outside the core business, what you might call moat-filling activities? Fourth, listen for technobabble. When management describes a new initiative or a recent acquisition, do they use clear, simple business language? Or do they hide behind a wall of futuristic jargon, buzzwords, and impenetrable acronyms? A lack of clarity often signals a lack of genuine understanding on their part. They are trying to impress you with their vocabulary because they can't impress you with the logic of their strategy. Finally, apply the why not test. This is a powerful contrarian approach. Instead of just looking at what the company did, actively search for instances where they chose times to do something. Did they choose not to enter a trendy new market that their competitors were all rushing into? Did they sell off a non-core division even when it was popular? A management team that can clearly articulate why they said no is a team that has a deep understanding of its own boundaries and a disciplined strategic focus. Their inaction is often more revealing than their action. The antithesis of this disciplined approach is a common corporate pathology we can call the synergistic fallacy. This is the path taken by the 99% of managers who believe they can achieve magical benefits called synergies by smashing together completely unrelated businesses. The CEO who falls for this fallacy believes that their personal management genius is a kind of universal solvent that can be applied to any industry with great success. This is the thinking that leads a staid industrial conglomerate to buy a volatile Hollywood movie studio, or a predictable consumer packaged goods company to acquire a high-risk biotechnology startup. The pitch to shareholders is always the same: diversification, cross-selling opportunities, and leveraging management expertise. The reality is almost always a disaster. The promised synergies are a mirage. The different business cultures clash, leading to an exodus of talent. The core business, the original source of the company's profits, begins to suffer from a lack of management focus and capital investment. The entire enterprise becomes a complex, inefficient, and bloated Frankenstein's monster of a company that is ultimately worth far less than the sum of its individual parts. Investors who buy into the synergy story are often left holding shares in a company that has no coherent identity and no clear path to creating value. They were sold a dream of a sleek, diversified machine, but they ended up owning a clunky, multi-headed beast. This is the inevitable outcome when management ego and a desire for empire-building triumph over the humble discipline of staying within a well-defined circle of competence. It is a direct route to the destruction of shareholder value and a clear failure of any reasonable test of corporate governance. The direct financial connection between staying within a circle of competence and shareholder returns is profound, and it centers on one crucial concept: the predictability of earnings. A company that operates within a well-defined, understandable business model with a clear competitive advantage has earnings and cash flows that are relatively stable and predictable. An investor or analyst can look at its history, understand its market position, and make a reasonably confident forecast of its future performance. This predictability is a highly valuable financial asset. Why? Because lower uncertainty translates to lower risk. And lower risk warrants a higher valuation multiple from the market. Think of it this way: Would you pay more for a bond that is guaranteed to pay you 5% every year, or a lottery ticket that might pay you 1,000% but will probably pay you nothing? Most rational investors would pay more for the certainty of the bond. In the same way, the market will consistently award a higher, more stable valuation to a company with predictable bond-like earnings than it will to a company with volatile, unpredictable lottery ticket earnings. A company that constantly strays from its circle of competence, chasing fads and making acquisitions in unrelated industries, is a company with lottery ticket earnings. Its future is a guessing game. This high level of uncertainty and risk will be reflected in a lower, more volatile stock price. By choosing to invest only with management teams that demonstrate the discipline to stay within their circle of competence, you are systematically tilting your portfolio towards businesses with more predictable earnings. You are choosing the bonds over the lottery tickets. This is a direct path to reducing portfolio volatility and building a collection of premium, blue-chip assets that are more likely to compound your wealth steadily and safely over the long term. This brings us to our fourth pillar, which is perhaps the most personal and revealing of all, the owner's mindset. A truly great manager doesn't just work for the shareholders. In their heart and in their mind, they are a shareholder. They treat the company's money with the same care and frugality as they would their own. They are not mercenaries, renting out their talent to the highest bidder. They are stewards, entrusted with the sacred duty of preserving and growing the capital of their partners. They think in terms of decades, not quarters. Buffett's world is filled with examples of these owner-managers, but none is more iconic, more perfectly illustrative of this mindset than Rose Blumkin, the legendary Mrs. B of the Nebraska Furniture Mart. Her story is the stuff of American business folklore. She was a Russian immigrant who arrived in America unable to speak a word of English. In 1937, with a $500 loan, she started a small furniture store in the basement of a building in Omaha. Her business philosophy was brutally simple and effective: sell cheap and tell the truth. She worked tirelessly, buying shrewdly, controlling costs with an iron fist, and passing the savings on to her customers. Over the next 5 decades, through sheer force of will and an unmatched work ethic, she built the Nebraska Furniture Mart into the single largest home furnishing store in the entire country, a retail behemoth generating hundreds of millions of dollars in annual sales. In 1983, Warren Buffett decided he wanted to buy the company for Berkshire Hathaway. He went to see the then 89-year-old Mrs. B. He asked her what the price was. She told him. He asked if she would compete with him. She said no. And on that basis, he bought 90% of the company. The deal was done with a simple 2-page contract and a handshake. Buffett never even had the company's books audited. As he explained later, "I'd rather have a handshake with Mrs. B than a 300-page contract with some other CEOs." He trusted her integrity and her character completely. But the most incredible part of the story came after the sale. Mrs. B, now a multimillionaire, could have retired to a life of luxury. Instead, she continued to show up for work every single day, well into her 100s, haggling with suppliers and riding her electric cart around the showroom floor. She treated every dollar of Berkshire Hathaway's money as if it were still her own. She was the ultimate owner-manager, a steward who was constitutionally incapable of wasting a single penny. Her frugal, customer-obsessed, owner-centric approach is the polar opposite of the lavish, self-serving culture that permeates so much of the corporate world. She is the gold standard for the owner's mindset. The reason the owner's mindset is so crucial is that it provides a powerful solution to one of the fundamental challenges of capitalism, the principal-agent problem. In any public company, the owners, the principals, which are the shareholders, are a diffuse group, while the people running the company day-to-day, the agents, which are the management team, are a concentrated few. This creates an inherent conflict of interest. An agent might be tempted to act in their own self-interest by, for example, voting themselves a massive salary, using a fleet of corporate jets for personal travel, or building a lavish, marble-clad headquarters as a monument to their own ego, rather than acting in the best interests of the principals, which is to maximize long-term shareholder value. This problem is supercharged by what Charlie Munger calls incentive-caused bias. This is the simple, powerful truth that human beings will almost always behave in ways that they are rewarded for. If you design a compensation system that rewards a CEO for hitting a short-term quarterly earnings target, they will move heaven and earth to hit that number, even if it means doing things that are damaging to the long-term health of the business, like cutting back on essential research and development, or using accounting tricks to pull sales forward from the next quarter. The owner-minded manager psychologically closes this gap between principal and agent. They solve the problem in one of two ways. Either they are, like Mrs. B before the sale, a significant owner themselves, with a huge portion of their personal net worth tied up in the company's stock. Or they have such a deep-seated ethical framework and sense of fiduciary duty that they simply cannot help but act as if they were the sole owner. They feel the pain of every wasted dollar. They take pride not in the perks of their office but in the efficiency of their operations. They are motivated not by short-term incentives, but by the long-term project of building a durable, profitable enterprise. Finding a manager who has successfully solved the principal-agent problem within their own mind is like finding a golden ticket for an investor. How can we, as outside investors, systematically identify this owner's mindset? We need a shareholder alignment scorecard, a 5-point checklist to cut through the noise and see if a management team is truly on our side. First and foremost is skin in the game. Look at the company's proxy statement and find out how much stock the CEO and other top executives own. But don't just look at the dollar value, look at it as a percentage of their total net worth. And critically, was this stock granted to them as part of their compensation package, or did they go out into the open market and buy it with their own hard-earned cash? A CEO who is consistently buying shares with their own money is sending the most powerful signal of alignment imaginable. Second, you must perform a detailed compensation structure analysis. Read the compensation discussion in the proxy. Is the CEO's bonus tied to metrics that truly build long-term value, like growth in intrinsic value per share, return on equity, or customer satisfaction? Or is it tied to short-term, easily manipulated metrics like quarterly earnings per share or the daily stock price? You want to see incentives that encourage long-term thinking, not short-term gimmickry. Third, read the proxies for executive perks. Is the company supporting a lavish lifestyle for its top brass? Are there multiple corporate jets, country club memberships, and personal financial planning services, all paid for by the shareholders? These perks are a clear sign of a mercenary mindset, a belief that the company's coffers are a personal piggy bank. A true steward is frugal with shareholder money. Fourth, apply the frugality test. Look for signs of a cost-conscious culture. What does the corporate headquarters look like? Is it a practical, no-frills workspace designed for efficiency, like the famously Spartan offices of Costco or Walmart? Or is it a gleaming glass tower in a high-rent district, designed to project an image of power and prestige? Frugality starts at the top and is a powerful indicator of an owner's mindset. Finally, pay attention to the communication style. In shareholder letters and on earnings calls, does the CEO refer to the company's money as our money, implicitly including the shareholders in that our? Or do they talk about the company's money as if it were an abstract pool of capital for them to deploy? This subtle linguistic cue can be incredibly revealing. A CEO who says our money is a CEO who sees you as a partner. The antithesis to the steward is a character that has become all too common in the modern market, the options-fueled gambler. This is the CEO whose compensation is overwhelmingly dominated by stock options. On the surface, this can look like alignment. They only get rich if the stock price goes up. But the structure of options creates a dangerous and perverse incentive. A stock option gives the holder the right, but not the obligation, to buy the stock at a set price. This means they have unlimited upside potential with absolutely zero downside risk. If the stock goes up, they become fabulously wealthy. If the stock goes to zero, they have lost nothing but a potential gain, while the actual shareholders have been completely wiped out. This heads I win, tails you lose structure encourages management to take massive, reckless, bet-the-farm risks with shareholder capital. They are incentivized to swing for the fences because a home run makes them rich and a strikeout costs them nothing personally. They are not acting as an owner who feels the sting of any loss and is therefore naturally more conservative. They are acting as a gambler who has been given a free seat at the high-stakes poker table and is playing with house money, your money. This compensation structure is one of the most destructive forces in modern corporate governance, directly encouraging the kind of short-term, high-risk behavior that so often leads to catastrophic blow-ups. It is the polar opposite of the prudent, long-term stewardship embodied by an owner-manager like Rose Blumkin. The direct financial connection between an owner's mindset and shareholder returns is found on the income statement, specifically in the area of expense control and profit margins. A manager with an owner's mindset is pathologically obsessed with efficiency and cost control. They view every dollar of expense, every unnecessary first-class flight, every catered lunch, every dollar spent on a fancy new office chair, as a dollar coming directly out of their own pocket and, by extension, the pockets of their shareholder partners. This relentless frugality translates directly into lower selling, general, and administrative (SG&A) expenses as a percentage of revenue. Over time, this operational discipline leads to wider and more sustainable profit margins. A wider profit margin means that for every dollar of sales the company makes, more cents fall to the bottom line as pure profit. This directly increases earnings per share, which is the primary driver of a company's stock price over the long term. A company run by a mercenary CEO might be able to grow revenues, but if that growth comes with bloated costs and shrinking margins, it is not creating value. A company run by a steward, by an owner-manager, will fight for every basis point of margin, creating a lean, efficient, and highly profitable enterprise. This is the direct mathematical link between the psychological trait of an owner's mindset and the tangible financial result of superior, long-term returns. This brings us to our fifth and final pillar, the one that synthesizes all the others into a practical, defensive strategy, the red flag radar. Having understood the importance of integrity, rationality, the circle of competence, and the owner's mindset, we must now learn how to spot their opposites. This pillar is about identifying and actively avoiding the charlatans, the promoters, and the value destroyers before they can inflict damage on your portfolio. For this, we must turn to one of the most infamous stories in modern business history, the rise and fall of Chainsaw Al Dunlap at Sunbeam. In the mid-1990s, Al Dunlap was a corporate celebrity. He had cultivated a reputation as a ruthless, brilliant turnaround artist. His nickname, Chainsaw Al, came from his signature move. He would be hired as the CEO of a struggling company, and he would immediately fire thousands of employees and shut down factories. The market loved it. When it was announced in 1996 that he was taking the helm at the sleepy small appliance maker Sunbeam, the stock soared by nearly 50% in a single day on his reputation alone. Dunlap was the archetypal promotional CEO. He was aggressive, supremely confident, and he told a simple, compelling story. I'm a tough guy who comes in, cleans house, and creates value for shareholders. But behind the story, a much darker reality was unfolding. Dunlap was not creating value. He was creating the illusion of value through massive accounting fraud. He used every trick in the book. He engaged in channel stuffing, forcing retailers to buy huge amounts of inventory they didn't need by offering them massive discounts, allowing him to book the sales in the current quarter. He used cookie jar reserves, setting aside huge, unnecessary restructuring charges in one quarter so he could bleed them back into earnings in future quarters to create the appearance of smooth, predictable growth. He booked phantom sales for products that were never even shipped. For a time, it worked. The reported earnings looked fantastic, and the stock price continued to soar. Analysts and investors, blinded by the compelling narrative and Dunlap's powerful personality, ignored the clear red flags in the financial statements. But you cannot defy financial gravity forever. In 1998, the house of cards came crashing down. The accounting shenanigans were exposed, the company had to restate its earnings, and the stock collapsed by over 90%, eventually leading to bankruptcy. Chainsaw Al Dunlap was the perfect embodiment of the manager who fails every single one of our tests. He lacked integrity, his actions were deeply irrational from a long-term perspective, he ventured into areas he didn't understand, and he was a mercenary of the highest order. His story is a permanent, smoldering monument to the capital that is destroyed when investors fail to activate their red flag radar. The psychological trap that ensnared investors in the Sunbeam saga is a combination of two powerful biases, the authority bias and the narrative fallacy. The authority bias is our deep-seated tendency to defer to and be more easily influenced by the opinion of an authority figure. Al Dunlap had been crowned by the financial media as a turnaround genius. He was an authority. Therefore, when he presented his rosy financial results, the market suspended its critical thinking and simply accepted them as fact. To question the numbers was to question the genius, and most people are psychologically uncomfortable doing that. Compounding this was the narrative fallacy, a concept powerfully described by the author Nassim Taleb. Our brains are not built to understand complex, raw data. They are built to understand stories. Dunlap provided a simple, powerful, and emotionally satisfying story. A tough hero comes to a struggling town, slays the dragons of inefficiency, and leads everyone to prosperity. This simple narrative was far easier to process and believe than the messy, complicated, and ultimately damning details hidden in the footnotes of the company's financial reports. Spotting the red flags of a charlatan requires the conscious effort to override these two biases. It requires you to question authority, no matter how credentialed or celebrated. And it requires you to deconstruct the seductive narrative and focus on the cold, hard, and often boring facts. It is the disciplined, analytical work that separates the professional from the amateur. To build this discipline, you need a systematic mental model, a forensic accounting pre-mortem. This is a 5-point checklist of red flags to look for before you ever invest, designed to help you spot the next Al Dunlap before they blow up your portfolio. First, as we've touched on before, is the flag of jargon versus clarity. If a CEO consistently uses overly complex language, an alphabet soup of custom-made acronyms, and impenetrable jargon to explain their business or their financial results, they are almost certainly hiding something. Great, honest managers, like Buffett, pride themselves on speaking in plain English. Complexity is the refuge of the charlatan. Second is promotional overload. How much time does the CEO spend curating their own celebrity, appearing on television, giving keynote speeches at conferences, being profiled in magazines, versus actually running the business? The CEO's primary job is to manage the company's operations, not its stock price or their personal brand. Excessive self-promotion is a giant warning sign that their focus is on the story, not the substance. Third, and most critical, is the hunt for accounting gimmicks. The most important place to look is the cash flow statement. Is there a large and growing divergence between the company's reported net income, its profit, and its actual cash flow from operations? If a company consistently reports huge profits but is burning through cash, that is the single biggest red flag in all of finance. It suggests the reported profits are not real. You must also scrutinize the balance sheet. Look for rapidly rising accounts receivable or inventory levels relative to sales, which can be signs of channel stuffing or phantom sales. Fourth is the critic test. How does management respond to critics, short sellers, or journalists who ask tough questions? Do they engage with the substance of the criticism, providing data and reasoned arguments to refute it? Or do they immediately resort to personal attacks, calling the critic a fool, a liar, or a market manipulator? Do they threaten lawsuits? A management team that aggressively attacks the messenger is almost always doing so because they cannot defend the message. Finally, apply the too good to be true indicator. If a company beats Wall Street's earnings estimates every single quarter without fail, year after year, with no volatility, you should be deeply suspicious. Real businesses have ups and downs. They face unexpected challenges. An unnaturally smooth, linear progression of earnings is often a sign of earnings management, or, in the worst cases, outright fraud. Remember Bernie Madoff's fund? His greatest red flag was that he never had a down month. Reality is lumpy. The opposite of this skeptical forensic approach is the path of the believer. This is the investor who becomes emotionally attached to a company and its management. Perhaps they love the company's products, or they are inspired by the CEO's vision. This emotional connection causes them to put on blinders. They want to believe the story. They join the online forums and social media groups filled with other believers, creating a powerful echo chamber where faith is reinforced and doubt is cast out. When negative news emerges, a critical analyst report, an article exposing questionable practices, they don't see it as a warning sign to be investigated. They see it as an attack on their tribe. They label it fake news or a short seller conspiracy. They ignore every single red flag we have discussed: the promotional hype, the accounting irregularities, the attacks on critics, because to acknowledge them would be to admit that their faith was misplaced. This is the psychology of the cult member, not the rational investor. The believer is the person who rides a fraudulent stock all the way down to zero, buying more on the way down, convinced they are getting a bargain. They are the inevitable bag holder, left standing in the rubble after the charlatan has absconded with the capital, wondering how everyone could have been so blind. But everyone wasn't blind. The skeptics, the ones who ran their forensic checklists, saw the disaster coming from a mile away. The believer's mistake was to let emotion and narrative triumph over evidence and analysis. The direct financial consequence of investing with a charlatan is often a specific, catastrophic event that appears on the financial statements, a massive goodwill write-down and balance sheet impairment. Here is how it works. When a promotional CEO overpays for an acquisition, a common move to create the illusion of growth, accounting rules require them to book the difference between the high purchase price and the fair market value of the assets they actually acquired as an intangible asset called goodwill on the balance sheet. This goodwill can sit on the balance sheet for years, inflating the company's stated assets and net worth. But eventually, when it becomes undeniable that the acquisition was a failure and will never generate the promised returns, the company is forced by its auditors to impair or write down the value of that goodwill. This results in a massive one-time charge against earnings that can wipe out a full year's worth of profits, or even the entire accumulated shareholder equity of the company. This is not just a non-cash, paper loss. It is the final, official accounting recognition of a past decision that resulted in the permanent destruction of shareholder capital. It is a financial tombstone, a lagging indicator of a long-past failure of management integrity and rationality. When you see a company take a huge goodwill write-down, you are witnessing the ghost of a bad decision made by a promotional CEO, a decision that a skeptical investor, with their red flag radar activated, could have and should have seen at the time it was made. You have made it to the end. You've invested your most valuable asset, your time, and in return, you have acquired a powerful new piece of mental hardware. You no longer just see a stock ticker or a fluctuating price on a screen. You now see every investment for what it truly is, a partnership with human beings. You have just installed the newspaper test into your operating system, a profound and permanent filter to separate the trustworthy stewards from the dangerous charlatans, protecting your capital from the single greatest risk in the market. But this filter, this crucial focus on management integrity, is only the first layer of the complete Buffett-style defense system. A trustworthy and rational captain is an absolute necessity, but a great captain is nearly useless if they are commanding a leaky, unseaworthy ship in a sea full of pirates. Knowing the character of the management team is half the battle. The other half is knowing the quality of the business itself. How do you analyze the ship? How do you determine if the business has an impenetrable, sustainable competitive advantage? What Buffett calls an economic moat that protects its profits from the relentless assaults of competition. The newspaper test ensures your capital is placed in safe hands. The next essential principle, the very idea contained in the video that is now on your screen, is the blueprint for ensuring those safe hands are steering an unstoppable world-compounding vessel. It is the critical bridge that connects a safe investment to a truly magnificent one. One principle protects your downside, the other unlocks your exponential upside. You have learned how to pick the jockey, a skill that already places you in the top tier of investors. But the true masters of the market, the ones who build generational wealth, also know how to pick the horse. The choice is simple. You can be content with what you've learned today and remain a cautious, protected investor. Or you can click on the video before you and complete the equation, forging the final link in the chain to become a truly formidable one. The map to financial freedom is laid out in front of you. The next step on the journey is yours to take.